were not capturing what was really going on in the economy. There were a lot of economists, famous economists and others, strategists as well, who were looking at the economy shutting down. And as you know, I was very focused on the possibility that this was a shock from which we would recover very quickly. And my conviction couldn't be higher that the innovation that has been evolving and was accelerated coming out of the coronavirus crisis is unstoppable, and the convergence between and among the 14 different technologies, that convergence is underway now and is causing and will continue to cause explosive growth, really the likes of which we haven't seen in our lifetimes. And when I say explosive growth, I mean when it comes to those innovation platforms, they're going to cause a lot of problems for the underlying economy, the traditional world order. A lot of strategies started moving towards benchmark sensitivity because of the tech and telecom bubble and bust. And they really stopped focusing on true innovation, transformative innovation, disruptive innovation. So the gleam in the eye, the dream during the tech and telecom bubble, investors were falling all over themselves to get the next deal and to ride it, up hundreds of percent within a few days. And we've got two companies here that are being dismissed as stay-at-home stocks that are going to fall back to earth. And we believe they are not stay-at-home stocks. They are stay-connected stocks, stay globally connected, stay competitive, stay globally competitive. Teladoc being the backbone of the healthcare system from an information point of view here in the United States. And Zoom becoming one of the most important companies, we believe, in the enterprise communication space. Communications is a $1.5 trillion market, enterprise communications globally. And we believe that Microsoft and Zoom together are going to benefit from the first, quote unquote, rip and replace cycle since the early days of the internet in the early 90s when Cisco came of age. We believe that the dismissal of these stocks is quite misplaced and suggests that analysts or investors are not doing their homework and sizing these markets appropriately. Leave those aside for a moment while we go through monetary policy, fiscal policy, economic indicators, and market signals to give you another point of view of how the algorithms and the quantitative strategies we believe are going to be wrong once again. So let's start with monetary policy. What has riled the market in the last week or so is Fed minutes being released suggesting that the Fed is going to become more aggressive at raising interest rates, perhaps sooner than many expected, maybe in the March timeframe. Now, what we believe has happened here is that the Fed, having suggested that inflation was transitory since the beginning of the coronavirus, was becoming concerned when it saw CPI inflation, headline inflation, year over year at 6.8%. And it does not want to be blamed for inflation being sustained and certainly not moving out of control. We think this is a bit of jawboning here. We think that some of the economic statistics that I'm going to share with you in a bit, the Fed knows very well. And those statistics suggest that inflation is indeed transitory. But on the off chance, and I'm sure there's a big debate going on at the Fed, there are going to be some Fed governors and Fed presidents who are looking at statistics and are citing some that are still on their way up. There are others who are going to be citing statistics that are on their way down. But they want to err on the side of hawkishness or being too tight right now, certainly from a jawboning point of view. because they don't want inflation to continue to escalate. On fiscal policy, that one's easy. Senator Manchin from West Virginia is basically saying he's not going to negotiate. I think he too has been citing inflation, debt, and taxes as three reasons not to spend more money. So we think the good news there is that some of the onerous tax increases that were part of that package will not go through. Now, on to economic statistics. And here again, this is the sort of analysis that we were doing at the beginning of the coronavirus, pulling out of these reports data that you are not hearing on CNBC, Bloomberg, newspapers. They're just not making the headlines. And today's employment report had something for the bulls and the bears. Headline non-farm payrolls, much lower than expected, 199,000, expectations 420,000. There was a slight increase, but not enough to make up for that difference, an increase in terms of revisions. On the other hand, there's another measure of employment. It's called household employment. That measure was up 650,000 after being up 1 million in the previous month. That's very strong. So the unemployment rate keeps coming down. What the bears, those who are expecting higher interest rates and higher inflation, focused on is average hourly earnings, which were up 0.6%. Interestingly, as we look through the report, it is the lower end of the wage range that is seeing some dramatic increases. So that is one indicator. The other is, again, reflecting on third quarter GDP statistics. In the third quarter of last year, real GDP was up 2.3%. It was a big disappointment relative to expectations. But what the headlines did not feature, and still are not featuring, is that practically all of that growth went into inventories. It wasn't sold. Real final sales were up a tenth or maybe 0.2. Even in the third quarter, inventories were starting to build at a time when everyone was talking about supply chain problems. And I think what we were beginning to see is the consumer getting quite upset that necessities, the prices of necessities, were escalating and destroying purchasing power. So that's interesting. Now on to market signals. The yield curve peaked at 130 it was February or March of last year. I think it was March. And has been falling. Now, the yield curve is the difference between short and long-term interest rates. Normally, long-term interest rates are higher than short-term interest rates. They were, as measured by the Treasury curve, so government bonds and notes, the yield curve, the longer-term bonds were 130 basis points, 1.3% higher than the 2-year yields in March of last year. At the end of last year, that number was 80 basis points, 0.8%. Today, it's 0.6%, even though bond yields are up, short yields are up more in response to the employment report and that 0.6% on average hourly earnings. The yield curve narrowing generally is not a good thing for financial stocks, but this rotation into value stocks, energy is up 5% this year. Energy's up 10%, financials up 5%, and they were two of the strongest sectors last year. Seems to be on automatic pilot. This yield curve would suggest that financials should start to underperform. In the fixed income world, we're also seeing credit spreads. So we look at junk spreads. So how much higher are low quality companies' yields or interest rates than higher quality? And right now we're seeing no disturbances, very little. The fixed income market is buying into this rotation into cyclicals. They haven't been paying attention perhaps to inventories in the way we are. Commodity prices are quite mixed, but most are just meandering, most prices in trading ranges. The dollar is up, and that is causing all kinds of problems in the emerging markets. The Turkish lira, as I mentioned on our last video, the Turkish people have lost half of their purchasing power in 1 year relative to the dollar. That's the Turkish lira. It's gone from 7 to about 14. It was as high as 18, nearly 20. And I think it's going to go back there because their foreign exchange reserves were cut in half the last month to something like $6 billion. $6 billion is nothing to withstand the onslaught of the currency speculators. And the dollar going up suggests a flight to safety, and that is a downward force on inflation. Commodities are priced in dollars, the dollar's going up, all other things equal, commodity prices would go down.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really, really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.